So you've found a house and you're ready to make an offer. What are the key terms you need to know about and what can set your offer apart? I'm gonna let you know right now. This is Aaron Chadbourne from Demetria's team, the Real Estate Group, and our team has the experience to help you buy or sell your home. The number one most important thing in an offer is the price. Now, we know what the asking price is and what's out there and what's advertised, but do we know what the seller expects? If the house has only been on the market for a short period of time, we can assume that the seller is expecting asking price or higher. If the property's been on the market maybe for 2 weeks, they might be thinking a little bit closer to asking price. If the property's been around a little bit longer than that, we might have some negotiating room. But the deal here is we're dealing with seller expectations. Sometimes we worry maybe a buyer is going to be just negotiating against themselves and bidding higher than they need to. That's why we created this thing called an escalation clause or an escalation addendum. That allows a buyer to start out with a base price offer and then offer to increase their offer if and only if a seller receives another higher offer. It's constructed in a manner that says, I'm willing to offer you this base amount and then X number of dollars, sometimes $1,000. I recommend at least $2,000, sometimes $5,000 or $10,000 over the next offer that you receive that's higher than mine. And you can specify a limit if that's what you want to do. Now, in order for a seller to be able to put that under contract with that addendum, they will need to show the buyer the defeated offer that they used to escalate the price. That's a way to make sure you're not bidding against yourself. But if there are multiple offers, likely the house is going to sell for above asking price to the buyer with the strongest terms. Which terms matter? Number one is financing. What are you using for financing? Now, there's an old saying that cash is king, and cash actually helps. But in the current market, cash doesn't mean that you're necessarily the buyer they're going with, and it doesn't mean that you're getting a discount. In this market, being a cash buyer means no discount, but a preference. You're the stronger buyer. In the event that you don't have the highest offer, they might come back and counter to you at the highest offer in their hand because they want the most money, but you've got the strongest terms. So if you can afford to pay cash or at least waive the financing contingency, meaning that you're going to take the risk and that you have a way to close if you don't get a loan, then that makes you stronger because again, it's taking risk away from the seller. If you are not able to waive financing, like most people can't, right? Most everyone needs a loan to buy a house. The next thing that matters is what kind of financing are you using? One thing that sellers will look at when they look at your offer and how strong you are is how much of a down payment are you putting down. A standard conventional mortgage is about 20% down. That allows you to avoid private mortgage insurance. 20% down tells a seller that you're pretty strong. You've got some skin in the game. You've got some cash. You've probably got a buffer if something goes wrong during the process. If things are found that are wrong, if the appraisal comes in low, you look like a strong buyer. There's also a great product that the credit unions offer called the CU Promise Loan that allows you to put as little as 10% down, between 10 and 19% down, and still not pay private mortgage insurance. For anything usually lower than 20% or less than 10% in the case of the CU Promise Loan, private mortgage insurance is required by the lender. What's private mortgage insurance? It means that you, the borrower, the buyer of the house, the borrower of the money to buy the house, are basically buying an insurance policy for the lender in the event that you default. Why does it kick in below 20% or below 10%? Because statistically speaking, people with less of a down payment are more likely to default on their mortgage. So the bank's making you buy an insurance policy so that they're always made whole. If you bought your house a while ago and you have PMI on your current loan, we might be able to get that off. So if you're doing that and your home value has gone up, give me a call and we can talk about how to get your lender to remove that PMI just because values have gone up. Now, if you're putting as low as 5% or 3% or 0% down, a seller is going to look at you, and if you're the only offer, you still might be okay. But if you are in a multiple offer situation, the type of financing and the amount of the down payment are going to matter. If you only put 3% down or if you put 0% down, what that says to a seller is you might have higher risk that if something comes up during the transaction, it might knock you out and you might not make it to the closing table. That's why down payment matters to the seller. In addition, there are a few types of government-backed funding programs. We all hear about FHA, and we hear about rural development, and we hear about VA loans. They're all great lending products, and they tend to be more favorable to you, the buyer. However, in this competitive buying market with low inventory, sellers look at how straightforward is the loan and how many hurdles are there. In exchange for the government being willing to give you lower rates for a lower credit score, or they put less scrutiny on the borrower profile, they put more scrutiny on the property, on the house. And so what that means is that a seller is absorbing more risk, that something could come up wrong with the property that you or the appraiser or the lender is going to flag. And if that happens, it means there's more risk to the transaction. That's why they're going to prefer conventional loans. So again, cash is usually strongest, conventional next, higher down payment is only going to be considered stronger, and then government-backed programs are going to come in a little bit lower than that in order of seller priority and seller preference. Now imagine you don't have enough money to be a cash buyer or to waive financing altogether. One thing you can do, and that we've seen a lot in the last few years, are guaranteed appraisal gap coverage. What does that mean? Well, for a typical loan, the bank is going to require an appraisal because they want to make sure if they ever have to foreclose on you, that the house is worth what they're lending you. If the appraisal comes in low, they're only going to lend on the appraisal amount. So if you're putting 20% down, the bank's lending 80%, the bank's only going to lend 80% of the appraised amount. Well, how are you going to make up the difference? Let's say you're under contract for a $400,000 house and the appraisal comes in at $380,000. We now have a $20,000 gap. What's going to happen? Well, what happens is that opens a new negotiation between the buyer and the seller because you can't get financing on the whole 400. Well, in a competitive environment, some buyers have been willing to say, hey, I've got some extra savings over and above what I need for my down payment and my closing costs. I'm willing to guarantee a certain amount of money. $5,000, $10,000, $20,000, some cases $100,000 or no limit at all, to say if the appraisal comes in low, I'll reach into my pocket and I'll make that up. Now, that only works for buyers who have extra money sitting in their bank accounts, right? You can only do it if you have the funds, and most sellers are going to want proof of funds. They're going to want to see that you actually have it. But that's one way, the appraisal gap clause, to make your financed offer stronger and compete on par a little bit with cash. Inspections, due diligence. I've recorded another video about why you should get them and why you should never waive them. However, in this environment, there are a lot of buyers who are waiving inspections. My rule of thumb is usually if there are more than 3 offers that have been submitted on a property, chances are one of them has waived inspections. So should you do it? Should you not do it? There's a lot to consider, and I direct you to the other video on my channel. Check it out here on YouTube. But if you're willing to waive inspections, you're basically taking the risk away from the seller. You're saying, look, I'm going to take all the risk. I can't back out of the contract. If I back out of the contract for any reason other than financing or one of the other contingencies you've written in, then you forfeit your earn it money deposit. If you're going to forfeit your earnest money deposit, you're taking the risk on yourself, the buyer, and that's why it makes you stronger as a seller. Now, there are a lot of things to get inspections for: the major systems of the house, if it has a septic system, it has a private well, the roof, the heating system. There are a lot of things to inspect, as well as to investigate whether there are any outstanding permit issues, whether you understand the zoning. There's a lot that you can look into. If you're not comfortable waiving inspections, there are some things we can do in order to strengthen your offer. One of them is to keep the number of days for inspections short. Our team has relationships with building inspectors that we can usually get in pretty quickly and get results back, so that if we're going to have a due diligence period, we can keep it short to make you more competitive and attractive to the seller. Number two thing you can do is oftentimes some buyers will say, look, we're not looking to nickel and dime you. We know that it's not a brand new house and not everything's going to be perfect. We'll guarantee an amount of money that if the repairs identified in an inspection don't exceed, then we're not going to ask for repairs. We're not going to ask for concessions. That tells the seller that you're serious and that you're coming to the table ready to buy and you're going to stay in the deal. Few other terms to think about. Closing date. When does the seller want to close? The average number of days it takes to close a loan, right, with all the steps that it takes with underwriting and appraisal, is somewhere between 30 to 45 days. Well, maybe the seller wants to close quicker. Maybe the seller wants to close in 60 or 90 days. That's an important thing for us to ask and find out. And if we can match the seller's preference based on your ability to do so, that might be helpful. In the last several years, some sellers have said, we want to have the closing a certain date and we'd like to rent back or maybe rent back for free for a certain period of time. We're seeing less of that as the market shifts, but if you're able to create other value for the seller, you might be able to win on terms, not just on price. Earnest money deposit. We spoke a little bit about that when we were talking about, if you back out of the deal and you have to forfeit the earnest money. Well, what's earnest money? It's a good faith deposit that gets specified in the contract, and it's the amount that gets held by one of the real estate companies in a trust account, and it gets applied toward the buyer's down payment or closing costs. As a rule of thumb, I don't like to have my buyers write earnest money, like the check that you have to write, and that check gets cashed and placed in an account. I don't like to see an earnest money deposit of less than 1% to 2% of the contract price. Now, that means on a $250,000 house, that's somewhere between $2,500 and $5,000. On a $400,000 house, we're talking about $5,000 to $10,000. Why do you have earnest money deposits? Well, the contract specifies that that's the amount of money that becomes fought over in the event someone defaults on the buyer, really. The buyer defaults on the contract. If it's below the threshold for small claims court, if there's ever a dispute over it, small claims court will settle that. If it's above that threshold, you'd go to mediation and get it settled that way. Now, what is the advantage of having a larger earnest money deposit? Like I said, it's not extra money. It gets applied toward the down payment and the closing costs. So why does it matter what the number is? Well, a larger number says I, the buyer, am willing to put up a larger amount of money at risk that I could forfeit if I'm a bad actor in the future. And that larger amount of money also signals to the seller that you have money, you have resources. So when people ask me about the earnest money and what I recommend and how much it should be. Again, usually I like to see it at least 2% of the contract price. And number two, a large number signifies that you're serious and you're willing to put your money where your mouth is. Finally, what else needs to go in an offer or what can set you apart? It's so important to ask if there's anything specific that matters to the seller. This is often something that an inexperienced agent won't do. They won't think to have the conversation. Sometimes it's the closing date, sometimes it's price, sometimes it's term, sometimes it's whether or not they can take something or a fixture or something else. Like, we need to know what that is, and you need to have a buyer agent that's going to go to the mat and help you figure it out. Now, at the end of the day, if it's a multiple offer situation, what we want to know is what your strongest bargaining position is and how to strengthen your terms and strengthen your price. Sometimes you're still not going to be successful in purchasing that house, but we're going to put our best foot forward so that if you're able to make the seller a deal that they'd be comfortable accepting, you know that you made your best effort. And we're going to be able to help you with that. So we'd love to work with you or any other buyers that you know that are trying to navigate this market, especially with the fluctuation in interest rates. Now is an important time to have an experienced team on your side. And our team here at Demetria's team, the Real Estate Group, would love to help you. If this has been helpful to you, please give us a like, give us a follow, and share this video with other people you think it could help. Thank you.